Hello everyone. Now let us start with second and final part of Pgbp in the booster series of lectures. For depreciation, I am going to make separate video. Other than depreciation, this is the final part for Pgbp. Let us start discussing about inadmissible deductions under section 40. First, let us start with section 40A 1A. See, whenever you are making payment, at the time of making payment, if you do not deduct TDS, then expenditure will not be allowed as deduction. There are two persons, payer, payee. Payer at the time of making payment. Sir, who is considered as payer? Payer is any person who is required to deduct TDS. You know TDS provisions, right? In Income Tax Act. As per TDS provisions, if any person is required to deduct TDS, that person we call as payer. Any person who is required to deduct TDS. Payee can be either person outside India or non-resident in India or foreign company. So payer who is required to deduct TDS, if he is making payment either to person outside India or if he is making payment to non-resident in India or if he is making payment to foreign company, then payer is required to satisfy two conditions. When he is required to satisfy two conditions at the time of payment. What are the two conditions? Condition 1, payer is required to deduct TDS. Sir, at what rate TDS is required to be deducted? That you will come to know in TDS chapter. So, payer at the time of making payment to person outside India or non-resident or foreign company, condition 1, payer is required to deduct TDS. Condition 2, deducted TDS is to be deposited to government. Deducted TDS is to be deposited to government. For condition 1, what is the due date? Condition 1 is payer is required to deduct TDS. Due date is within previous year. Within current previous year only, he is required to deduct TDS. Condition 2, deducted TDS is required to deposit to government. For deposit to government, what is due date? Due date is on or before due date for ITR under section 139(1). So on or before ITR due date under section 139(1), deducted TDS is required to be deposited to the government. What is the conjunction? Conjunction is and. Only if both these conditions are satisfied, then only such payment is allowed as deduction to the payer. So whenever payer is making payment to the payee can be either non-resident in India or person outside India or foreign company. Payer is required to deduct TDS within the previous year and deducted TDS is required to be deposited to government within the due date for filing ITR under section 139(1). If both these conditions are satisfied, C1 and C2 satisfied, then whatever the payment is there, this payment is 100% allowed as deduction to the payer. Is it clear? So if both the conditions are satisfied, 100% of payment is allowed as deduction to the payer. Are you able to understand? Now you will get a doubt. Sir, what if condition 1 not satisfied or condition 2 not satisfied or condition 1 and condition 2 both are not satisfied? In this case, 100% of the expenditure is disallowed. So the expenditure is not allowed as deduction. Is it disallowed permanently? No, it is not disallowed permanently. In current previous year, it is disallowed. So 100% of the expenditure is disallowed in current previous year. Sir, if it is disallowed in current previous year, what about in future? In future, whenever deducted TDS is deposited to the government, then it is allowed as deduction on payment basis. Are you able to understand? Here you can see 100% of the such expenditure shall be disallowed, but the same will be allowed as deduction in the year of actual TDS payment to the government. So in subsequent years, whenever deducted TDS is deposited to the government, in that year it is allowed as deduction. So allowed as deduction in subsequent years, but allowed as deduction in subsequent years on payment basis. I will tell one example so you will understand. Mr. Raju is there. He is making payment to non-resident in India. So he is required to deduct TDS, right? Now let us see various cases. Case 1, TDS deducted on 20 March 2025. Deducted TDS deposited to government on 14th June 2025. Now for Mr. Raju, what is due date for filing ITR? Let's say for him tax audit is not applicable. So for him due date for filing ITR is 31st July 2025. So due date for ITR 31st July 2025. Now we have to check conditions. Payer is any person who is required to deduct TDS. Payer is making payment to non-resident. So payer is required to deduct TDS, right? First condition, he is required to deduct TDS. When he is required to deduct TDS, TDS is required to be deducted within the previous year. So what is current previous year? 24-25. So whether TDS is deducted within the previous year, 20 March 25 means previous year 24-25 only. So condition 1 satisfied. Condition 2, deducted TDS is deposited to government on or before due date for filing ITR. Due date for filing ITR is 31st July. It was deposited on 14th June. Condition 2 also satisfied. So as both the conditions are satisfied, deduction allowed. In which previous year deduction is allowed? Deduction is allowed in current previous year 24-25. Are you able to understand first example? Now, second example. TDS deducted on 25th March 2025. Deducted TDS is deposited to government on 4th September 2025. Now whether condition 1 is satisfied, TDS is deducted within the previous year only. So condition 1 satisfied. Condition 2, deducted TDS is to be deposited to government before ITR due date. What is ITR due date? 31st July 25. When it was deposited? 4th September. 4th September means after 31st July, right? So condition 2 not satisfied. As both the conditions are not satisfied, as condition 2 is not satisfied, in 24-25 deduction is not allowed. Sir, again when deduction is allowed? In the previous year in which TDS was paid. When TDS was paid? TDS was paid in 25-26. So deduction is allowed in 25-26. Is it clear? Are you able to understand? Now, let us see third example. TDS deducted on 7th April 25. Deducted TDS is deposited to government on 30 May 2025. Whether condition 1 is satisfied, condition 1, TDS to be deducted in current previous year. When it was deducted? 7th April. 7th April means 25-26, right? So, condition 1 not satisfied. TDS was not deducted in current previous year. Condition 2, deducted TDS is deposited to government on 30 May. 30 May means before 31st July, right? So condition 2 satisfied. Only if both the conditions are satisfied, then only 100% of the expenditure is allowed. So here both the conditions are not satisfied. So in 24-25, deduction is not allowed. When deduction is allowed? Deduction is allowed in 25-26. When TDS was actually paid? TDS was actually paid in 25-26, right? So in 25-26, TDS was also deducted and deducted TDS is deposited to the government. In 25-26, both the conditions are satisfied. So in 25-26, deduction is allowed. Are you able to understand? Next, fourth condition. TDS deducted on 9th March 2025, but deducted TDS is deposited to government on 3rd June 2027. Whether condition 1 is satisfied, payment is made in 24-25, TDS was also deducted in 24-25. So condition 1 satisfied. Second condition, deducted TDS is to be deposited to government before ITR due date. What is ITR due date? 31st July 25. But when it was deposited 3rd June 27, is it deposited before 31st July 25? No. Condition 2 not satisfied. If both the conditions are not satisfied, deduction is not allowed in 24-25. Sir, again when deduction is allowed? Deduction is allowed in the year in which it is actually paid to the government. When TDS was actually paid to the government? TDS was actually paid to the government in previous year 27-28. So in previous year 27-28, this will be allowed as deduction. Now hope you got clarity. So payer can be any person who is required to deduct TDS as per provisions of Income Tax Act. Payee should be person outside India or non-resident in India or foreign company. Payer at the time of making payment to payee, payer is required to satisfy two conditions. Condition 1, TDS to be deducted within current previous year, deducted TDS to be deposited to government before ITR due date. If both these conditions are satisfied, then such payment, 100% of the expenditure is allowed as deduction in current previous year. Otherwise, such payment is not allowed as deduction in current previous year. Such payment is allowed as deduction in future in the year in which deducted TDS is actually deposited to the government. Are you able to understand? Next, 40A 1A. Payer should be any person who is required to deduct TDS, but payer should be making payment to resident in India. So 40A1 speaks about payment to non-resident in India or payment to foreign company or payment to a person outside India. When payment is made to resident in India, then 40A1A comes. Same provision as it is. Any person who is making a payment to resident in India, then he is required to deduct TDS, and deducted TDS is to be deposited to the government. Same provision. 40A1A. Here who is payer? Payer is any person who is required to deduct TDS. Who is payee? Payee should be resident in India. So payer at the time of making payment to payee, payer is required to satisfy two conditions. Condition 1, deduct TDS within current previous year. Condition 2, deducted TDS to be deposited to government before ITR due date. What is the conjunction and? If both these conditions are satisfied, then 100% of the expenditure is allowed. 100% of the expenditure is allowed as deduction to the payer. Otherwise, payer cannot claim such expenditure as deduction. If C1 is not satisfied, or if C2 is not satisfied, or C1 and C2 both are not satisfied, in this case 30% of the expenditure is disallowed. 30% of expenditure is disallowed. My client making payment of audit fees to me, he paid 1 lakh rupees audit fees to me. Now before making payment, I am resident in India. He is required to deduct TDS under section 194J at the rate of 10%. Now my client has to satisfy two conditions. My client has to deduct TDS to me within current previous year, deducted TDS is to be deposited to government before ITR due date. Then only audit fees paid by my client is allowed as expenditure to my client. Out of these two conditions, if any condition is not satisfied, then audit fees is not allowed as expenditure. Sorry, audit fees is allowed as expenditure, but only 70% is allowed and 30% is disallowed. Are you able to understand? If any one of the conditions are not satisfied, 30% of the expenditure is disallowed. For example, client paid 1 lakh rupees directly, he did not deduct TDS. He forgot to deduct TDS. Next year he came to know. So TDS is to be deducted within current previous year. In 24-25, did he deduct TDS? He did not deduct TDS. Now even though he paid 1 lakh rupees to me, 1 lakh rupees is not allowed as deduction in P&L account. Only 70,000 rupees is allowed as deduction. 30,000 rupees is disallowed in my client's P&L account. Are you able to understand? So this is all about 40A1 and 40A1A. Now let us discuss section 40B. In case of partnership firm, there will be P&L account, right? In that P&L account, if partnership firm wants to claim remuneration to partners as expenditure, or if partnership firm want to claim interest to partners as expenditure, that expenditure is allowed as deduction, but subject to section 40B. Only if conditions specified under section 40B are satisfied, then only for a partnership firm, interest on partners capital or interest on partners loan or remuneration to partners is allowed as expenditure. Otherwise, such expenditure is not allowed as deduction. So, before claiming remuneration as deduction in P&L account of partnership firm or interest on partners capital as deduction in partnership firm P&L account, check the conditions given under 40B. If these conditions are satisfied, then only interest on partners capital or remuneration to partners is allowed. Shall we see the conditions? Yes. First, interest on partners capital and remuneration to partners should be authorized by and inconsistent with partnership deed. What do you mean by this? Only if partnership deed authorizes payment of interest on partners capital or remuneration to partners, then only those expenses are allowed as deduction. Partnership deed is silent with regard to remuneration to partners. Remuneration to partners is not allowed as deduction. Partnership deed is silent. It did not specify interest on partners capital. Now interest on partners capital is not allowed as deduction. Only if partnership deed authorizes, then only interest on partners capital or remuneration to partners is allowed as deduction, and that too whatever the amount that is specified in partnership deed is there, only that much amount of interest on partners capital or remuneration is maximum allowed as deduction. Is it clear? So interest on partners capital, remuneration to partners is allowed as deduction in accordance with the partnership deed, only if partnership deed specifies. Next, remuneration to a working partner or interest to a partner authorized by deed but relates to earlier period is not allowed as deduction. What do you mean by this? Interest on partner's capital, remuneration to partner. These two are allowed as deduction on prospective basis. They are not allowed as deduction on retrospective basis. That means the day on which amendment is done in partnership deed with regard to interest and remuneration, from that date onwards, whatever the interest and remuneration is there, only that is allowed as deduction. Before that date, if like interest on partners capital and remuneration is not allowed as deduction. I will tell one example. Previous year 24-25. What is the range? 1st April 24 to 31st March 2025. So on 1st April 24, partnership deed was written. No remuneration clause is there. No remuneration clause is there. Again, on 1st July 2024, remuneration clause added. With effect from 1st April 2024. What I said, remuneration to partners is allowed as deduction only if it is mentioned in partnership deed. In the initial partnership deed, whether remuneration to partners is mentioned, it is not mentioned. When it was mentioned in the amendment, when amendment was done on 1st July 2024, partnership deed was amended and remuneration clause was included. But how remuneration clause was included? Remuneration clause was included with effect from 1st April 2024 onwards. Even though remuneration clause is included with retrospective effect, here it is retrospective effect. Even though remuneration clause is included with retrospective effect, whatever the remuneration for this period is there, that is not allowed as deduction. Only remuneration from the date of amendment will be allowed as deduction. The date on which remuneration clause is included in the partnership deed, from that date onwards, whatever the remuneration is there, only that remuneration is allowed as deduction. Even though partnership deed authorizes for retrospective payment of remuneration, still that remuneration is not allowed as deduction. From change date, from amendment date, whatever the remuneration is there, only that is allowed as deduction. Is it clear? Good. Next. Interest paid to both working and sleeping partners are allowed as deduction. See, you are paying interest for working partner as well as for sleeping partner. Both interests are allowed as deduction in P&L account. But in case of working partner, in case of remuneration, only if it is paid to working partner, then only it is allowed as deduction. Is it clear? So, interest, whether it is paid to working partner or sleeping partner, interest on partner's capital is allowed as deduction. Remuneration to partners, only if it is paid to working partner, then only it is allowed as deduction. Is it clear? Next. Sir, is there any limit? Yes, there are limits. Whatever the interest that is paid, total interest is not allowed as deduction as per Income Tax Act. Maximum interest on partner's capital allowed is 12% simple interest. Is it clear? So there is a formula. Maximum interest allowed is equal to interest as per partnership deed or interest actually paid or 12% simple interest, whichever is lower. Let's say partnership deed authorized 20% interest. Partnership said, deed said 20% interest should be paid to partners. Actual interest paid to partners is 18%. Maximum interest allowed as per Income Tax Act is 12%. Whichever is lower means maximum interest allowed as expenditure under Income Tax Act is 12%. Is it clear? So, in case of interest, maximum interest allowed is interest as per partnership deed or interest actually paid or 12%, whichever is lower. That is the maximum interest allowed as deduction under provisions of Income Tax Act. Next, in case of remuneration. In case of remuneration, remuneration is allowed as deduction subject to these conditions. That means total remuneration is not allowed. For remuneration also, there is formula. Maximum remuneration allowed to all partners. Maximum remuneration allowed to all partners is equal to actual remuneration paid to working partners. Why I am using working partners? Because if remuneration is paid to sleeping partners, that is not allowed as deduction. Only if remuneration is paid to working partners, that is only allowed as deduction. So maximum remuneration allowed for a partnership firm with regard to remuneration to partners is actual remuneration paid to working partners or remuneration based on book profits, whichever is lower. This anyhow you know, remuneration paid to working partners, you go to accounts, P&L account, you will know remuneration paid to working partners. Now, how to calculate remuneration based on book profits? See, if there are no book profits, then remuneration based on book profits is equal to 5,40,000. That means if there are book losses or if there are no book profits, remuneration based on book profits is equal to 5,40,000. If there are book profits, then two things are there. If book profits are less than or equal to 6 lakhs, then remuneration based on book profits is equal to 90% of book profits or 3 lakhs, whichever is higher. Third case, case 1 done. Case 2 we have discussed. Case 3, if book profits are greater than 6 lakhs. If book profits are greater than 6 lakhs, then remuneration based on book profits is equal to, on first 6 lakhs, 90% of book profits or 3 lakhs, whichever is higher, plus on balance book profits, 60% of book profits. So if book profits are greater than 6 lakhs, remuneration based on book profits is equal to, on first 6 lakhs, 90% of book profits or 3 lakhs, whichever is higher, on balance book profits, 60% will be considered as remuneration based on book profits. We will do one problem so you will get understanding. Let's say book profits are 9 lakhs. Now we have to calculate remuneration based on book profits. On first 6 lakhs, what is the rule? What is the formula? 90% of book profits. That means 90% of 6 lakhs or 3 lakhs, whichever is higher, plus on balance book profits. How much are balance book profits? Balance book profits are 3 lakhs. So 6 lakhs into 9% means 5.4 lakh or 3 lakh, whichever is higher. That means 5.4 lakh. Plus balance book profits are 3 lakhs, right? 3 lakhs into 60%. How much 3 lakhs into 60%? 1,80,000. So in total 7,20,000. So if book profits are 9 lakhs, remuneration based on book profits is equal to 7,20,000. Now did you understand how to calculate? Good. Sir, you are quite often saying book profits. What book profits means and how to calculate book profits? That is the question. Book profit means net profit before remuneration and after Pgbp adjustments. See, this is the format. First, you have to take net profit as per accounts. From net profit as per accounts, you will calculate book profits. In accounts, if remuneration is already claimed as expenditure, then you will add back remuneration. If remuneration is already claimed as expenditure, you should add back remuneration. If remuneration is not claimed as expenditure, don't add back. Next. Then you will get net profit before remuneration as per accounts. What you want is net profit before remuneration. If remuneration is already allowed as deduction, then you have to add back remuneration. Thereby you will get net profit before remuneration. Listen patiently, I will tell one problem, you will get clarity. And then you have to do Pgbp adjustments. Expenses disallowed, add back. Incomes disallowed, you have to reduce. Okay, you have to do Pgbp adjustments. Thereby you will arrive at net profit before remuneration and after Pgbp adjustments. That we call as book profit. Is it clear? Now I will tell one small example so that you will get clarity. P&L account is like this. Sales 130 lakhs. Winnings, you know winnings from lottery, right? Winnings 4 lakhs. Next, allowable expenses 70 lakhs. Remuneration to partners 40 lakhs. Penalty 2 lakhs. Interest at the rate of 16% on partners' capital 4 lakhs. Now how much is net profit? 134 minus 70 minus 40 minus 2 minus 4. Net profit is 18 lakhs. So this is basically accounts P&L account. Accounts P&L account. Now we have to calculate remuneration based on book profits. Shall we calculate book profits? What I told, what is the format? You have to take net profit as per accounts. How much is net profit as per accounts? Net profit as per accounts is equal to 18 lakhs. To that, what you need to do? You need to add back remuneration. Why I am adding back remuneration? Because here remuneration was claimed as expenditure. If remuneration is not claimed as expenditure in P&L account, in accounts, don't add back. Only if remuneration is claimed as expenditure, then only add back the remuneration. How much is remuneration? 40 lakhs. So add remuneration 40 lakhs. So 58 lakhs. This is net profit before remuneration, before claiming remuneration as deduction, before remuneration and Pgbp adjustments. Now, shall we do Pgbp adjustments? See, winnings, this is taxable under other sources. Is it taxable under the head Pgbp? It is not taxable under the head Pgbp. So, should it be credited to P&L account? It should not be credited to P&L account. So, 4 lakhs you will less income taxable under other head. How much? 4 lakhs. That you will less because that income is not taxable under the head Pgbp. Next, penalty. As per section 37, penalty is not allowed as deduction. So you need to add back penalty. That expenditure is disallowed. So disallowed expenditure should be added back. How much is penalty? Penalty is 2 lakhs. Next. Interest on partner's capital. How much interest? 16%. Maximum interest allowed as per Income Tax Act is only 12%. So 12% allowed, 4% disallowed. Correct? Now, how much is 4%? For 16% interest is 4 lakhs. For 4% how much it is? Do calculation. For 4% it is 1 lakh. So, how much interest to partner's capital is disallowed? 1 lakh interest to partner's capital is disallowed. So, add back disallowed interest on partner's capital. How much? 1 lakh. So, now you will get net profit before remuneration and after Pgbp adjustments. This we also call as book profits. How much are book profits? 58 minus 4 plus 3. 57 lakhs. So book profits are 57 lakhs. Now, shall we calculate maximum remuneration allowed as per Income Tax Act? Maximum remuneration allowed as per Income Tax Act is equal to actual remuneration paid to working partners or remuneration based on book profits, whichever is lower. How much is remuneration based on book profits? See, here book profits are 57 lakhs. Shall we calculate book profits 57 lakhs? Now on first 6 lakhs, balance book profits. Balance book profits are how much? Balance book profits are 51 lakhs. So remuneration based on book profits is equal to, on first 6 lakhs, 90% of book profits. That means 5.4 lakhs or 3 lakhs, whichever is higher, plus on balance book profits 60% of 51 lakhs. How much? 5.4 lakhs plus 51 lakhs into 60%, 30 lakhs 60,000. So in total, how much is allowed? 36 lakhs is remuneration based on book profits. Now tell me, how much is actual remuneration? Actual remuneration is 40 lakhs. So actual remuneration paid to working partners is 40 lakhs or remuneration based on book profits. How much are remuneration based on book profits? 36 lakhs. Whichever is lower means 36 lakhs is allowed as deduction. So out of 40 lakhs remuneration, 36 lakhs is allowed, 4 lakhs is disallowed. Now are you able to understand how to calculate book profits and how to calculate maximum remuneration allowed to partners? Good. Taxability in the hands of partners. See, whatever the salary that is allowed as expenditure to partnership firm is there, the same salary is taxable in the hands of the partners under the head Pgbp. So interest remuneration to partners, whatever the amount that is allowed as deduction to partnership firm is there, same amount is in turn taxable in the hands of partners under the head Pgbp. The reason is, in between partnership firm and partner, there is no employer-employee relationship. That's why whatever the remuneration that is received, even though it is named as salary, it is not taxable to the partner under the head salary, but it is taxable under the head Pgbp. Net profit. On net profit, partnership firm will pay tax, right? After payment of taxes, balance profit will be distributed to partners. Share of profit received by partner from a partnership firm is not taxable, it is fully exempt. The reason is partnership firm had already paid the tax liability. Is it clear? Good. Next, section 40A2. What section 40A2 says? Section 40A2 says that excess payment made to specified person is not allowed as deduction. Excess payment to specified person. Specified person means nothing but relative. Specified person is not allowed as deduction. 40A2 is applicable only for payments. From relative you got excess income. That excess income is also taxable because 40A2 is applicable only for expenses. So if you make any excess payment, that excess payment is not allowed as deduction. That excess payment is disallowed. Please remember, in examination he will confuse you. He will give excess income received from relative, tax it completely. 40A2 is not applicable there. 40A2 is applicable only for payments. Next. For example, I will tell one small example. A, B, C. These three are chartered accountants. All of these three together formed a partnership firm, A, B, C and Co. So they have started a very big office. Father of Mr. A has hotel. So every day from hotel, lunch will be served to 40 employees that are there in the CA office. Generally, meal cost is 120 rupees. Fair value of the meal is 120 rupees. But payment made by ABC and Co is 180 rupees. Obviously, father of Mr. A is relative to ABC and Co. Father of Mr. A is specified person to ABC and Co. Now ABC and Co. every day it is paying 120 rupees to hotel, Father A's hotel. Sorry, 180 rupees to Father A's hotel. This is payment made. However, market value is only 120. How much excess payment was made? excess payment is 60 rupees, right? The excess payment of 60 rupees is not allowed as deduction. Is it clear? So whenever any excess payment is made to specified person, nothing but relative, then such excess payment is not allowed as deduction under the head Pgbp. Please remember, 100% of the expenditure is not disallowed, only excess expenditure is disallowed. So 48 is applicable only for payments, and those payments should be made to specified person, then only 48 is applicable, and whatever the payment that is made is there, that payment should be a excessive payment, then only disallowance provisions will get attracted. So payment should be in respect of expenditure. Such payment should be made to a specified person, and such payment is considered excessive or unreasonable. So in this case, whatever the excess payment that is made by assessee is there, that will be disallowed by the assessing officer. Sir, you are saying relative. Relative means who? In case of individual, relative means spouse, brother, sister, any lineal ascendant or descendant. See, only 5 persons are covered under the definition of relative for 40A2. Who are they? Spouse, brother, sister, any lineal ascendant, descendant. Lineal ascendant means what? 3 generations upwards. Mother, father, grandmother, grandfather, great grandmother, great grandfather. Lineal descendant means 3 generations downwards. Son or daughter, grandson or granddaughter, great grandson or great granddaughter. Are you able to understand? So for an individual, relative means these 5 category of persons. That means only if payment is made to these 5 category of persons, then only disallowance gets attracted. Are you able to understand? If payment is made to other than these 5 persons, then that expenditure is allowed as deduction. For example, payment is made to spouse's brother. Whether spouse brother is covered under the definition of relative, spouse brother is not covered under the definition of relative. So for spouse brother, if any payment is made, 48 will not get attracted. Are you able to understand? Now, sir, you are telling specified person. Sir, who is called as specified person? In case of individual, for individual, relative is a specified person. That means any excess payment made to relative is not allowed as deduction. Relative means spouse, brother, sister, lineal ascendant, lineal descendant. For these 5 category of persons, if an individual makes excess business payment, that is not allowed as deduction. Not only relative, any other business or profession, in which either individual or relative of the individual or relative of individual is having substantial interest. You know substantial interest, right? More than or equal to 20% stake, beneficial ownership. I will tell this point through an example. Mr. A, he has gold business. Mrs. A, she has silver business. Gold business made excess payment to silver business. Whether this excess payment is allowed, this excess payment is not allowed. The reason is payment is made to relative. See, like payment is made to a business in which a relative is having substantial interest. See, in silver business, Mrs. A is having 100% stake, right? So whatever the payment, excess payment made by Mr. A to Mrs. A is there, that is not allowed as deduction. Is it clear? Now, there is Mr. R. He is into event management business. You know event management, right? For a marriage, they will take care of everything. Mrs. R and Miss J, both of them have boutique. You know boutique, right? Mrs. R share is 60%, Miss J share is 40%. Now boutique provided makeup services to Mr. R, event management business. Fair market value is 80,000. Actual payment made is 1.3 lakhs. So event management company, they made excess payment. How much is the excess payment in this scenario? Excess payment is 50,000. Whether this 50,000 is allowed as deduction or not. First of all, Mr. R is having one business, event management business. That business is making payment to boutique. See, in boutique, relative of the individual is having substantial interest. Wife of Mr. R, wife of Mr. R. So, wife of Mr. R is relative to Mr. R and wife is having 60% stake. That means wife is having substantial interest in the boutique business. For individual, relative is obviously a specified person. Payment made to relative not allowed as deduction. Not only relative, if any payment is made to any business in which either individual is having substantial interest or relative of the individual is having substantial interest. Here in this case, payment is made to boutique business where Mrs. R is having substantial interest, where relative of Mr. R is having substantial interest. Now, whatever this excess payment that is made is there, that is also to be disallowed. Are you able to understand? So, in case of individual who is specified person, relative is obviously a specified person. Not only relative, any other business or any other profession in which either individual or relative of the individual is having substantial interest. Even that other business or profession is also considered as specified person, and if any excess payment is made, that is not allowed as deduction. Is it clear? So for individual, these are considered as specified persons. Relative, any business or profession in which individual or relative of the individual is having substantial interest. Sir, in case of partnership firm, who is considered as specified person? Obviously, in case of partnership firm, partner is considered as specified person. That means if any excess payment is made to partner, not allowed as deduction. Not only partner, relative of partner is also considered as specified person. The example we discussed in the beginning, excess meal payment 60 rupees made to hotel run by father of Mr. A. Okay, not only partner, even for relative of partner also, if any excess payment is made, that is not allowed as deduction. Not only partner or relative of partner, any other business or profession in which either partnership firm or partner or relative of the partner. Okay, partnership firm or partner or relative of partner is having substantial interest. Now, even that other business is also considered as specified person, and any excess payment is made, that is not allowed as deduction. Next, in case of company, director is considered as specified person. Any excess payment made to director, not allowed as deduction. Not only director, relative of director is also considered as specified person. For relative of director, if any excess payment is made, not allowed as deduction. Any business or profession in which company or director or relative of the director, if they are having substantial interest, company or director or relative of director is having substantial interest, even that business or profession is also considered as specified person, and for that business or profession, if this company makes excess payment, that is not allowed as deduction. Is it clear? So in case of HUF or AOP, whoever the members are there, members are considered as specified persons. If HUF or AOP makes excess payment to its own members, such excess payment is not allowed as deduction. For HUF AOP, not only members, if any excess payment is made to relative of the member, that is also not allowed as deduction. HUF AOP, if they are making excess payment to other business, In that other business, if the member or relative of the member is having substantial interest, then payment, excess payment made to such other business is also not allowed as deduction. So this is all about 40A2, excess payment made to specified person not allowed as deduction. Now let us discuss about section 40A3. What section 40A3 says? As per section 40A3, for a single person in a single day, you should not make cash payment more than 10,000. You should not make cash payment more than 10,000. If you make cash payment of more than 10,000 for any expenditure to a single person in a single day, then that cash expenditure is not allowed as deduction. Is it clear? Sir, then what is the solution? For a single person in a single day, if you want to make expenditure payment of more than 10,000 rupees, you should make such payment only by way of bank transaction. Then only it is allowed as deduction. Sir, what do you mean by bank transaction? You should make payment by way of either account payee check or account payee bank draft or any other electronic clearing system. Electronic clearing system means phone pay, net banking, like this, or any other electronic mode, debit card, credit card. Okay, the whole idea is to account for the details of the recipient. If you make payment through bank transaction, the recipient details are available. That's why this rule was brought into. For a single person in a single day, you should not make cash payment of more than 10,000 rupees. If you want to make expenditure payment of more than 10,000 rupees, you should make payment only by way of bank transaction. If you make cash expenditure payment of more than 10,000 rupees, then 100% of expenditure is disallowed. See, 40A2, only excess payment is disallowed. 40A3, 100% of the expenditure, total payment will be disallowed. Are you able to understand? But when you are making payment to transport operator, up to 35,000 rupees you can make cash payment. Beyond 35,000 rupees for a single person in a single day, if you make cash payment to transport operator, that is not allowed as deduction. Generally, the limit under section 40A3 is 10,000 rupees. However, if you are making payment to transport operator up to 35,000 rupees in a single day, for a single person, you can make cash payment. More than that, it will not be allowed as deduction. There are certain cases, exceptions. Exceptions means what? Cases where 40A3 provisions are not applicable. See, in some cases, 40A3 provisions are not applicable. Where payment is made to RBI, banks, cooperative bank, primary agricultural credit society, primary credit society, land mortgage bank, LIC, State Bank of India and its subsidiaries. See, I want to take keyman insurance policy for my profession. In my profession, I am the keyman, right? I went to LIC. It said premium is 40,000 rupees. 40,000 I made in cash. I made payment in cash. Total 40,000 is allowed as expenditure because 40A3 provisions are not applicable. Whenever payment is made to LIC, scheduled bank, RBI, cooperative bank, SBI and its subsidiaries, then for these category of persons, even if you are making cash payment of more than 10,000 rupees, still that expenditure is allowed as deduction because 40A3 provisions are not applicable. Where payment is made to government, I wanted to pay municipal taxes. Municipal taxes are 35,000 rupees. I went to municipal office, I paid 35,000 in cash. Even though I am paying cash payment of more than 10,000 rupees, still municipal taxes are not disallowed and they are allowed as deduction because municipal taxes are amount payable to government. For amount payable to government, 40A3 provisions are not applicable. Is it clear? Next. Where payment is made by way of book adjustment. What do you mean by book adjustment? I will tell with one small example. There is A, there is B. B sold goods to A sold goods to B. What is the entry whenever goods are sold on credit basis? Debtor account debit to sales account. 8 lakhs were sold. Now B paid 5 lakhs to Mr. A. At the time, what is the entry that will be passed? Bank account debit to debtor account. 5 lakhs, 5 lakhs. Balance 3 lakhs are unpaid. B is not paying balance 3 lakhs. So what Mr. A did? Mr. A purchased 3 lakhs worth of goods. When Mr. A purchases 3 lakh worth of goods, Mr. A has to make the payment, right? But Mr. A did not make the payment. Mr. B is required to pay 3 lakhs to Mr. A. Against this debt of 3 lakhs, Mr. A purchased 3 lakhs worth of goods. Now what is the entry that will be passed? Purchases account debit 3 lakhs to, here debtor means who? Debtor means nothing but Mr. B, right? Debtor means nothing but Mr. B. So Mr. B account is pending 3 lakhs. Now what is the entry that will be passed? Purchases account debit to Mr. B account 3 lakhs. Are you able to understand? Mr. B is required to give 3 lakhs to Mr. A. Mr. B is not giving. So Mr. A went to Mr. B shop. He took goods worth 3 lakh rupees and came back to his shop. So Mr. A purchasing 3 lakhs worth of goods, and how is he making payment? He is making payment by way of adjusting the debtor against purchases. Here for 3 lakh rupees purchases, payment was made. How that payment was made? The payment was made by way of adjusting the previous debt. Are you able to understand? So payment by way of adjusting the previous debt, this we call as book adjustment. Here 3 lakhs was paid, no outflow of cash, but there is cancellation of debtor. So without outflow of cash, through book adjustment, if any payment is made, for that payment 40A3 provisions are not applicable. Simple reason, as there is no outflow of cash. Next, where payment is made for the purpose of agricultural or forest produce. See, you are purchasing agricultural produce, or you are purchasing like dairy or poultry or animal related products. You are purchasing fish or fish products. You are purchasing products of horticulture and apiculture. Apiculture means what? Beekeeping, honey processing. So whenever you are purchasing these products from cultivators, growers or producers, that means what? You are not purchasing from middlemen. If you directly purchase agricultural produce, forest produce, all these kinds of products from the cultivators or growers, then even though for them you are making excess payment of more than 10,000 rupees, still disallowance will not get attracted and total expenditure will be allowed as deduction. Please remember, you are purchasing agricultural products from middleman. For middleman, if you make cash payment of more than 10,000 rupees, that is not allowed as deduction, because exception is there only if you purchase directly from cultivators. Where payment is made for the purpose of purchase of products manufactured without aid of power in a cottage industry. See, I purchased handicrafts. Handicrafts are handmade products. There is no power that will be used in making of handicrafts. So whenever you are purchasing the products which are manufactured without aid of power, so for purchase of those products, even though you make cash payment of more than 10,000 rupees, such expenditure is allowed as deduction. Where payment is made in a village or town which on the date of such payment is not served by any bank or to a person who ordinarily resides or is carrying on any business or profession in any such village or town. You wanted to make payment of 80,000 rupees to a person, but the place where you want to pay that 80,000 rupees, in that village or in that town, there is no bank at all, or bank is there, on the date of payment bank is holiday. In that exceptional scenario, even though if you make cash payment of more than 10,000 rupees, that is allowed as deduction. Where payment is made by way of salary to an employee, and when such employee is temporarily posted for a continuous period of 15 days or more in a place other than his normal place of duty or on a ship and does not maintain any account in any bank at such place or ship. Do you know Dabur company? Dabur company is engaged in manufacturing of wide range of products. Normally Ayurvedic products Dabur will manufacture. So Dabur has group of scientists. One scientist is working in Dabur Limited as an employee. Dabur Limited asked scientist to go to Sundarban forest in West Bengal and do research over there for 1 month. Now this scientist has to go to West Bengal and Sundarban forest. He has to stay there for 1 month. There no mobile signal will be there. How can he eat? How can he meet his expenses? That's why Dabur gave 2 lakh rupees cash to him. Now 2 lakh rupees expenditure is spent by Dabur in the form of cash to a single person in a single day. Still that expenditure is not allowed as deduction. The reason is payment is given to employee and he is posted in another place other than his normal place. His normal place is Delhi, for example, but he is posted in West Bengal for more than 15 days. And in Sundarban forest, he does not have bank account. So even the 2 lakh rupees cash is given by Dabur Limited to such employee, that is not disallowed, it is allowed as deduction. Where payment is made by any person to his agent, who is required to make payment in cash for goods or services on behalf of such person. There is principal, there is agent. Agent is purchasing agricultural products. From whom? From farmers only agricultural products are being purchased. Now, for agricultural products purpose, agent has to make 30,000 cash payment. For this purpose, principal gave agent 30,000 cash payment. For agent, this is allowed as deduction. This is allowed as deduction under point 4. Under point 4, if any amount is paid for purchase of agricultural products, even though cash payment is made, allowed as deduction. And whatever 30,000 cash payment made by principal to agent is there, that is also allowed as deduction under point number 8. Are you able to understand? Agent is required to make cash payment. So principal gave cash payment to agent. Whatever the cash payment given by principal to agent is there, that is also allowed as deduction under point 8. Next, where payment is made by an authorized dealer or money changer against purchase of foreign currency or traveler's checks in the normal course of business. You know foreign exchange dealers, right? Foreign exchange dealers, like my friend came from USA. He has $1,000 with him. What he can do with $1,000 in India? So in airport, he sold, like he gave those $1,000 to foreign exchange dealer. In return, foreign exchange dealer gave cash to my friend. So foreign exchange dealers, they will purchase foreign currency. At the time of purchase of foreign currency in their normal course of business, even if they make a cash payment of more than 10,000 rupees, still that amount is allowed as deduction. So my friend, how many dollars he is having? $1,000. Authorized dealer made 90 rupees for each dollar. 90,000 paid to my friend. For my friend, 90,000 rupees is an income. For authorized dealer, 90,000 rupees is expenditure, cash expenditure. Even though it is cash expenditure, this 90,000 is allowed as deduction. Is it clear? Now let us discuss section 43B. See, there are 6 payments covered under 43B. For these 6 payments, there is separate tax treatment. How many payments are covered under 43B? 6 payments, right? So these 6 payments, if they are paid in current previous year, allowed as deduction in current previous year. If these 6 payments are not paid in current previous year, then we have to check whether these are paid before ITR due date or not. ITR return filing due date. So what is due date for filing ITR? 31st July or 31st October, correct? So these 6 payments, if they are not paid in current previous year, then check if they are paid before ITR due date. That means either 31st July or 31st October. In such case, allowed as deduction in current previous year. If not paid before ITR due date, then allowed as deduction on payment basis. Allowed as deduction on payment basis. Simple. So whatever the 6 payments covered under 43B are there, you take any Pgbp problem, without 43B adjustment, there will not be such problem. That much important this provision is, listen carefully. Whatever the 6 payments covered under 43B are there, those 6 payments are allowed as deduction in current previous year only if they are paid in current previous year. If they are not paid in current previous year, then we have to check whether these 6 payments are paid before ITR due date or not. If these 6 payments are paid before ITR due date, then allowed as deduction in current previous year. If they are not paid before ITR due date, then they are allowed as deduction on cash basis. One of the payment covered is leave encashment. Any sum paid by SSC as an employer in the lieu of earned leave of his employee. So, employer is paying leave encashment for previous year 24-25. If this leave encashment is paid in 24-25, then allowed as deduction in 24-25. If leave encashment is not paid in 24-25, then what is the ITR due date? Generally, ITR due date is 31st July or 31st October of assessment year, correct? 31st July of assessment year or 31st October of assessment year. If leave encashment is not paid in 24-25, then if leave encashment is paid before ITR due date, so ITR due date is 31st July of assessment year. For previous year 24-25, what is assessment year? 25-26, correct? So 31st July 25 or 31st October 25. If leave encashment is paid before ITR due date, then allowed as deduction in current previous year only, allowed in previous year 24-25. If leave encashment is paid after ITR due date, then it is allowed as deduction on payment basis. In which year that amount is paid, in that year leave encashment is allowed. Let's say leave encashment not paid in 24-25 but paid on 10th November 25. 10th November means what? After 31st July, right? 10th November is after 31st July, after 31st October. 10th November means what? Leave encashment is paid after ITR due date. Now this is allowed as deduction in 25-26 because it was paid during the previous year 25-26. Another example, leave encashment was paid on 4th April 2006. Not paid in 24-25, not paid in 25-26, but it was paid in 26-27. So it is allowed as deduction in 26-27. Are you able to understand the mechanism? So whatever the 6 payments covered under 43B are there, if they are paid in current previous year, allowed as deduction in current previous year. If they are paid in next year, okay, assessment year, then you have to check whether they are paid before ITR due date or after ITR due date. If they are paid before ITR due date, allowed as deduction in current previous year only. If they are paid in assessment year after ITR due date, then they are allowed as deduction on payment basis. Is it clear? Now, let us see what those 6 payments are. Any sum payable by way of tax, duty, cess. See, whatever the amount payable to government is there by any law for the time being in force. Amount payable to government, GST, municipal taxes, stamp duty, whatever the amounts payable to government are there, they are covered under 43B. Those payments are allowed as deduction only if they are paid in current previous year. If they are paid in subsequent previous year, if they are paid in subsequent years, then if they are paid before ITR due date, allowed as deduction in current previous year. Otherwise, they are allowed as deduction on payment basis. Employer contribution to Provident Fund. This I have already discussed. When I am explaining section 36(1), I told employer contribution is subject to 43B. So employer contribution paid in current previous year, allowed as deduction in current previous year. Employer contribution paid in assessment year, next year. If it is paid before ITR due date, allowed as deduction in current previous year. Otherwise, it is allowed as deduction on payment basis. Next, bonus or commission, even that is also allowed as per provisions of 43B. Interest payable on loan. See, whenever you take loan, on loan you are required to pay interest, right? So whenever you take loan from public financial institution, state financial corporation, state industrial investment corporation, scheduled bank, cooperative bank, NBFC, from these category of persons, if you take any loan, on that loan you are required to pay interest, right? Such interest is allowed as deduction as per the provisions of 43B. Leave encashment I have already discussed. Any sum payable by SSC to Indian Railways for use of railway assets. In Vijayawada railway station, there is a railway canteen. Every month railway canteen will pay rent to Indian Railways, right? Such rent expenditure is allowed as deduction as per 43B. That means whenever you are using the railway assets, for that you are making any payment, that payment is allowed as deduction as per provisions of 43B. Very simple. Any amount payable to Indian Railways is allowed as deduction only if it is paid in current previous year. If it is paid in next previous year, if it is before ITR due date, allowed as deduction. If it is after ITR due date, not allowed as deduction. Is it clear? See, there is a recent amendment, section 43BH. Listen very carefully. Only if you listen, then only you will understand this concept. Otherwise, you will not understand this concept. Very careful. There is supplier. There is also buyer. Supplier is a micro or small enterprise. Who is called as micro or small enterprise? That we will see later. But here in this example, supplier is a micro or small enterprise. Supplier sold goods or services on credit basis. You know credit basis, right? Not on cash basis. In case of cash basis, immediately cash will be received. Here supplier is selling goods or services to buyer on credit basis. Now, whenever goods are sold on credit basis, there will be credit period, right? We have to check now whether there is agreement between supplier and buyer is there or not. If agreement is there between supplier and buyer, then due date is equal to credit period allowed or 45 days, whichever is lower. If agreement is not there, if agreement is not there between supplier and buyer, then due date for payment is equal to 15 days. Due date for payment is equal to 15 days. As per Income Tax Act section 43BH and as per section 15 of MSME Act 2006, supplier and buyer entered into agreement for credit period of 60 days. Generally 60 days may be allowed, but as per Income Tax Act, maximum credit period allowed is 60 days or 45 days, whichever is lower. That means amount should be made, payment should be made within 45 days. Okay. So whenever supplier is micro or small enterprise and he is selling goods or services to buyer on credit basis, if there is agreement between supplier and buyer, then due date for payment is equal to credit period agreed or 45 days, whichever is lower. If there is no agreement, then as per section 15 of MSME Act 2006, due date is equal to 15 days. Now, in this scenario, if payment is made within due date, expenditure allowed as deduction on accrual basis. If payment is made after due date, expenditure allowed as deduction on cash basis. Here, payment before ITR due date, that concept is not applicable. If payment is made after the due date, that's it. Expenditure is not allowed as deduction on accrual basis, but it is allowed as deduction on cash basis. Here due date is 15 days. If payment is made within the due date, allowed as deduction on accrual basis. If payment is made after due date, allowed as deduction on cash basis. Is it clear? Good. I will tell one example. Supplier is there, buyer is there. Supplier is covered under is a micro or small enterprise. Supplier sold goods on credit basis on 12th March 2025. When the goods are sold? On 12th March 2025. There is agreement. Agreement is there. As per the agreement, credit period is 50 days. Whether 50 days is allowed? 50 days is not allowed as per Income Tax Act. Maximum credit period allowed is 45 days. So due date is equal to 50 days or 45 days, whichever is lower. That means due date is 45 days. So will you calculate the due date? So 12th March, right? Balance how many days are there? 31 minus 12. In March, 19 days are there. 45 minus 19. 26th April. So due date is 26th April. In this case, let's say payment made before 26th April. On or before 26th April. Then it is allowed as deduction in 24-25. Are you able to understand? As payment is made before the due date, allowed as deduction on accrual basis. When transaction was entered in 24-25, so it is allowed as deduction on accrual basis. Payment made after due date, after 26th April, then it is not allowed as deduction on accrual basis, it is allowed as deduction on cash basis. So 26th April 25, it falls under the previous year 25-26, so it is allowed as deduction in 25-26, it is not allowed as deduction in 24-25. Are you able to understand? So this is the concept relating to section 43B(h). Only if payment is made before the due date, then only deduction is allowed on accrual basis. If payment is made after the due date, it is allowed as deduction on cash basis. See, 26th April 2025, it is before ITR due date. Even though it is before ITR due date, still expenditure is not allowed as deduction on accrual basis, and expenditure is allowed as deduction only on payment basis. See, don't confuse here. For initial 6 payments before ITR due date. For MSME payment, the exact due date. If payment is made before exact due date, allowed as deduction on accrual basis. If payment is made after due date of MSME Act, even though it is paid before ITR due date, still it is allowed as deduction on cash basis. Is it clear? Even though it is paid before ITR due date, not allowed as deduction in 24-25, still it will be allowed as deduction in 25-26. Is it clear? Another point. These 6 payments are there, right? Even though SSC is following accrual basis of accounting, these 6 payments are allowed as deduction as per 43B. If they are paid in current previous year, allowed as deduction in current previous year. Paid in assessment year, if they are paid before ITR due date, allowed as deduction in current previous year. Otherwise, allowed as deduction on payment basis. So, micro or small enterprise definition you can see here. Next, where interest on loan is converted into loan, interest so converted will not be treated as having been actually paid. What do you mean by this? There is Mr. Raj. He took 10 lakhs loan. On 10 lakhs loan, let's say interest first year is 11%. Interest is 1,10,000. Second year, 1,10,000. Third year, 1,10,000. Fourth year, 1,10,000. So total 4,40,000. Now this loan is taken from SBI. SBI is a scheduled bank, right? So whenever you take loan from scheduled bank, then interest is allowed as deduction as per 43B. Only if it is paid, then only allowed as deduction. But 4 years interest was not paid. Is it allowed as deduction? If interest is not paid, it is not allowed as deduction. In 5th year, this 4,40,000 was converted as second loan. 4,40,000 was converted as second loan. Just because 4,40,000 is interest amount is converted into loan, deduction is not allowed under Pgbp. Now, this 4,40,000 will be paid over remaining period, right? Let's say this loan is to be paid over a period of 2 years. That means 2,20,000 in first year and 2,20,000 in second year. So in subsequent years, that means in 5th year and in 6th year, 2,20,000, 2,20,000, if that interest is actually paid, then it is allowed as deduction. Is it clear? So just because interest amount is converted into loan, you cannot consider it as interest paid and you should not claim it as deduction. In future, whatever the interest amount that is characterized as loan is there, interest amount characterized as loan, if it is paid in the form of repayments, then the year in which that interest amount characterized as loan paid is there, in that year it is allowed as deduction. Is it clear? Next, 44AA, maintenance of books of accounts. See, 44AA basically answers 3 questions. First question is, what are all the books of accounts that are required to be maintained? Second question is, place where books of accounts are required to be maintained. Third question is, period for which books of accounts are required to be maintained. First, I will discuss place where books of accounts are required to be maintained. Where business is going on or where profession is going on, in that place only books of accounts are required to be maintained. If business is going on at multiple places, then books of accounts are required to be maintained at principal place of business or profession. If the business is having branches and separate set of books are maintained for branches, then Books of accounts relating to branches can be maintained at respective branch offices. Simple. Generally, books are to be maintained at place of business or profession. If multiple places means they are to be maintained at principal place of business or profession. If branches are there and separate set of books are maintained for branches, they are to be maintained at respective branch offices. Simple. Period. Books of accounts are required to be maintained for 6 years from the end of relevant assessment year. So, let's say there is previous year 24-25. What is corresponding assessment year? Assessment year is 25-26. From ending of 25-26, you have to consider 6 years. 26-27, 27-28, 28-29, 29-30, 30-31, 31-32. So 31st March 30-32. Previous year 31-32. Till end of previous year 31-32, books of accounts are required to be maintained. If you calculate from end of assessment year, it is 6 years. If you calculate from end of previous year, it is 7 years. Is it clear? Now, what are all the books of accounts that are to be maintained? If SSC is a notified professional, sir, who are called as notified professionals? Those who are engaged in these professions, they are considered as notified professionals. Legal profession, advocates, medical, doctors, engineers, architectural profession, interior decoration, accountancy, technical consultancy, authorized representative, film artist, director, singer, lyric writer, art director, company secretary, information technology consultants. So all these are considered as notified professionals. For notified professionals, we will check turnover. There is only one criteria, turnover criteria. So in case of existing profession, that means if profession is already in existence, if gross receipts exceed 1,50,000 in all the 3 years, very important, all the 3 years immediately preceding the previous year. In case of newly set up profession, his gross receipts are likely to exceed 1,50,000. So for existing profession, we will check last 3 years. For newly set up profession, we will check only current previous year. What he is saying? What is current previous year? Current previous year is 24-25. Ignore 24-25. Take last 3 previous years. What are last 3 previous years? 23-24, 22-23, 21-22. What is the conjunction and? All 3 years, for all 3 years, if turnover is greater than 1,50,000. If turnover is greater than 1,50,000, then he is required to maintain books of accounts as per rule 6F. Then he is required to maintain, if above conditions are satisfied, then required to maintain books of accounts as per rule 6F. What are all the books of accounts as per rule 6F? Cash book, journal, ledger, carbon copies. See, when in business, receipts will be given, invoices will be given. Whenever you receive more than 25 rupees, for that you have to give the receipt, and you have to maintain vouchers for all the expenses. If notified professional is a medical professional, that means if notified professional is a doctor, along with these 5 books of accounts, additionally he is also required to maintain daily case register, and he is also required to maintain opening and closing stock of, inventory means what? Stock. Opening and closing stock of all the medicines and consumables that are used by him in that previous year. So those notified professionals who satisfy this condition, they are required to maintain books of accounts as per rule 6F. They have to maintain these books of accounts. And they are also required to maintain daily case register and opening and closing stock of inventory of medicines. If these conditions are not satisfied, then they are required to maintain minimum books of accounts. Minimum books of accounts means what? Through these books of accounts, income tax officer will be able to calculate the assessee's total income. Minimum books of accounts means ledger and cash book. If ledger and cash book is there, they are sufficient to the extent possible. Income tax officer can calculate the total income. So notified professionals, if they satisfy this condition, they are required to maintain books of accounts as per Rule 6F. If they do not satisfy these conditions, then they are required to maintain minimum books of accounts. Is it clear? So for newly set up profession, you are qualified, like you got qualified CA in current previous year only. So you have to expect, if your gross receipts in profession are likely to exceed more than 1,50,000, then you are required to maintain books of accounts as per Rule 6F. Is it clear? Next, business SSCs and non-notified professionals. See, some of the professionals are not notified here. Okay, priest, he is not notified. Okay, astrologer, he is not notified. So whoever the non-notified professionals and other business SSCs are there, for them, we will check two criteria, income criteria or turnover criteria. Conjunction is or. That means what? Out of income criteria and turnover criteria, if any one of the criteria is satisfied, sufficient. They are required to maintain books of accounts. If both criteria is not satisfied, then they are not required to maintain books of accounts. Are you able to understand? So I explained about notified professionals. Now I am explaining about business SSCs and non-notified professionals. So how many criteria they have? They have two criteria, either income criteria or turnover criteria. If any one of the criteria is satisfied, then they are required to maintain minimum books of accounts. If income criteria is not satisfied, turnover criteria is also not satisfied, then they are not required to maintain books of accounts. Is it clear? Now, what income criteria? In case of existing business, if the income is exceeding 1,20,000 in any one of the 3 years preceding the relevant previous year. What do you mean by this? What is current previous year? Current previous year is 24-25. You have to take last 3 previous years. Previous year 23-24, previous year 22-23, previous year 21-22. What is the conjunction? Conjunction is or. Out of last 3 previous years, right now we are discussing about income criteria. In last 3 years, for any one of the previous years, what is the conjunction that I have used? Or for any one of the previous years, for individual or HUF, if total income is less than or equal to 2.5 lakhs, no books of accounts. Books of accounts are not required to be maintained. If total income is greater than 2.5 lakhs, then minimum books of accounts are required to be maintained. For other persons, if total income is greater than 2.5 lakh, then minimum books of accounts. If total income is greater than 1.2 lakhs. If total income is less than or equal to 1.2 lakhs, then no books of accounts are required to be maintained. Is it clear? So this is the crux. For other category of persons, income limit is 1,20,000. For individual or HUF, income limit is 2,50,000. This is income criteria. If income criteria is satisfied, books of accounts are required to be maintained. If it is not satisfied, then you have to check turnover criteria. If turnover criteria is also not satisfied, then you have to maintain. Then if turnover criteria is also not satisfied, then books of accounts are not required to be maintained. See turnover criteria. Existing business or profession. Turnover is exceeding 10 lakhs. 2.5, not 2.5 lakhs, it is 25 lakhs in case of individual or HUF. Here also 25 lakhs in case of individual or HUF. So next, turnover criteria. What is current previous year? Current previous year is 24-25. Ignore current previous year. Take last 3 previous years, 23-24, 22-23, 21-22. Conjunction is or out of last 3 previous years for any one of the previous year. In case of individual or HUF, in case of other persons. In case of individual or HUF, what you need to consider? You need to consider if turnover is less than or equal to 25 lakhs, no books of accounts. If turnover is greater than 25 lakhs, then minimum books of accounts are required to be maintained. For other persons, if turnover is greater than 10 lakhs, then minimum books of accounts are required to be maintained. If turnover is less than or equal to 10 lakhs, no books of accounts are required to be maintained. Is it clear? Are you able to understand? So this is the discussion about 44AA. One more thing, if books of accounts are not maintained, then penalty of 25,000 will be levied under section 271A. So the default for non-maintenance of books of accounts is penalty of 25,000 rupees. Let us discuss 44AB, provisions with regard to tax audit. First, let us see requirement of tax audit in case of business SSC. Whenever a business person comes to you, you should ask this question first. Sir, in your business, if cash receipts are less than or equal to 5% of total receipts and cash payments are less than or equal to 5% of total payments, conjunction is and. So in their business, if cash receipts are less than or equal to 95% of total receipts and cash payments are less than or equal to 95% of total payments. If both these conditions are satisfied, then up to 10 crore rupees tax audit is not required. Tax audit is required only if turnover is more than 10 crores. If these conditions are not satisfied, either one or both the conditions are not satisfied, then tax audit is required if turnover is more than 1 crore. Simple. Generally, in case of business SSCs, if turnover is more than 1 crore rupees, then they have to get their books of accounts audited by a chartered accountant under section 44AB. However, in case of business SSCs, if their cash receipts are less than or equal to 95% of total receipts, and if their cash payments are less than or equal to 95% of total payments, then up to 10 crore rupees they are not required to get their books of accounts audited. Only if their turnover is more than 10 crore rupees, then only books of accounts are required to be audited. In case SSC is engaged in profession, so for a professional, if gross receipts are less than or equal to 50 lakhs, he is not required to get his books of accounts audited. A doctor is there. In his profession, gross receipts are 47 lakhs, less than 50 lakhs, right? Professional, like doctor is not required to get his books of accounts audited. If gross receipts are greater than 50 lakhs, then doctor is required to get his books of accounts audited by a chartered accountant. See, once books of accounts are audited, audit report is required to be submitted 1 month before the due date for filing ITR under section 139(1). Generally, those who are required to get audited, for them, what is due date for filing ITR? Due date for filing ITR is 31st October of assessment year. 1 month prior to 31st October means what? 1 month prior to 31st October means that is 30th September of assessment year. Are you able to understand? That means on or before 30th September of assessment year, tax audit report is required to be submitted by the SSC. For companies, tax audit report is submitted in form 3CA and 3CD. For other category of persons, tax audit report is submitted in form 3CB and 3CD. Sir, what if books of accounts are not audited? If books of accounts were not audited, then penalty will be levied. Penalty is equal to 0.5% of turnover or 1,50,000, whichever is lower. Are you able to understand? So if books of accounts are already audited under any other statute, for example, Companies Act. If books of accounts are already audited under Companies Act 2013, then separately from scratch, books of accounts are not required to be audited. Statutory audit report as per Companies Act is required to be submitted. Along with that, audit report under Form 3C and 3CD is also required to be submitted. Next, Presumptive Provisions, Section 44AD, 44ADA and 44AE. Let me discuss section by section. First, I will discuss section 44AD. Who can choose 44AD? Resident individual, resident HUF, resident partnership firm other than LLP. That means what? Non-residents, they cannot choose presumptive section 44AD. Presumptive section under section 44AD is available only for residents, resident individual, resident HUF, resident partnership firm but not LLP, and those who are choosing 44AD, they should not claim deduction under section 10AA. Next, who can choose? That means resident individual, resident HUF, resident partnership firm other than LLP, when they can choose 44AD. If they are engaged in these businesses, then they cannot choose 44AD. So any business or profession other than a person earning income in the nature of commission or brokerage. So those whose income is commission income or brokerage income, they cannot choose 44AD. Those who are notified professionals also cannot choose, because for notified professionals there is separate section called 44ADA. Next, those who are doing agency business, they also cannot choose 44AD. Person engaged in the business of plying, hiring or leasing of goods carriages, because for them separate section 44AE is there. So who can choose 44AD? 4 people. Other than these 4 people, remaining all businesses or professions can choose 44AD. What are these 4 businesses which cannot choose 44AD? Those who are earning income by way of commission, they cannot choose 44AD. Those who are doing agency business, they cannot choose 44AD. Those who are notified professional, they cannot choose 44AD. Those who are doing business of plying, hiring or leasing of goods carriages, they also cannot choose 44AD. Next, what are the conditions? 44AD can be chosen only if turnover is less than or equal to 2 crores. I am doing business. In my business, turnover is 8 crores. Can I choose 44AD? No. 44AD can be chosen only if turnover is less than or equal to 2 crores to help small businesses to help small businesses from maintaining books of accounts and getting their books of accounts audited. Presumptive provisions are introduced. If their turnover is less than or equal to 2 crores, they are not required to maintain books of accounts. They are not required to get their books of accounts audited if they choose 44AD. But they can only choose 44AD if their turnover is less than or equal to 2 crores. There is one exception. What is that exception? If cash receipts are less than or equal to 95% of total receipts, 95% of turnover. In such a case, up to 3 crore rupees 44AD can be chosen. Generally, up to 2 crore rupees turnover only 44AD can be chosen. However, if cash receipts are less than or equal to 95% of total receipts, if answer to this question is yes, then up to 3 crore rupees 44AD can be chosen. If answer to this question is no, then up to 2 crore rupees only 44AD can be chosen. Is it clear? Next, how much is presumptive income? Presumptive income is equal to 8% of cash turnover plus 6% of bank turnover. That will be considered as presumptive income. One point here. If any amount is received by way of bearer check or crossed check, that amount will also be considered as deemed to be received in cash. Only if amount is received through account payee check, then only it will be considered as bank transaction. If amount is received by way of bearer check or crossed check, it will be deemed as cash receipt only. Next, Once if SSC chooses 44AD, he will calculate presumptive income, 8% of cash turnover plus 6% of bank turnover. From presumptive income, he cannot claim expenses under section 30 to 38. Expenses under section 30 to 38 are not deductible. Another point here, 6% of bank turnover. See, bank turnover can be received either in current previous year or it can be received before ITR due date. Even that bank turnover is also eligible for 6% calculation. So whatever the bank turnover belonging to current previous year, received in current previous year, on that you will apply 6%. Whatever the bank turnover belonging to current previous year but received in next previous year before ITR due date, on that bank turnover also you will apply 6%. Next, I already told you, if SSC is choosing provisions under section 44AD and is paying tax on presumptive income, he is not required to maintain books of accounts and he is not required to get his books of accounts audited under section 44AB. However, if SSC declared presumptive income under section 44AD in any financial year, then he is required to declare presumptive income for subsequent 5 years. What do you mean by this? Let's say current previous year is 24-25. In 24-25, he chose 44AD. For next 5 years, he should choose 44AD. Next 5 years are 25-26, 26-27, 27-28, 28-29, 29-30. For example, in 25-26, 44AD chosen. 26-27, 44AD chosen. 27-28, he got losses. So he did not choose 44AD. So from next year onwards, for the next 5 years, SSC cannot choose 44AD. So what is the punishment? Once you disclose your income under 44AD, for the next 5 years you have to disclose under 44AD. In the next 5 years, if you do not disclose under 44AD, the year in which you are committing the default, okay, leave that year. From next year onwards, over a period of 5 years, SSC cannot choose 44AD. And SSC is required to maintain books of accounts. And SSC is required to get his books of accounts audited if his total income is greater than basic exemption limit. Is it clear? Once SSC chooses 44AD, next 5 years he has to choose 44AD. In next 5 years, in any 1 year if he does not choose, from the year of default, leave that year, from next year onwards, next 5 years he cannot choose 44AD. And he is required to maintain books of accounts and he is required to get his books of accounts audited. You can see, in case of violation, SSC is not eligible for presumptive provision for subsequent 5 years after the year of default. SSC covered under 44AD4 is required to maintain books of accounts and get his accounts audited if his total income exceeds basic exemption limit. Next, advance tax. Those who are choosing 44AD, they are not required to pay advance tax in 4 installments. It is sufficient they pay advance tax in a single installment on or before 15th March. Next, let us discuss 44ADA. Who can choose 44ADA? Resident individual can choose 44ADA. Resident partnership firm also can choose 44ADA, but not LLP. What do you mean by this? See, who can do profession? Artificial persons cannot do profession. So resident individual, resident partnership firm, only natural born persons can be a professional. So either individual or partnership firm, group of individuals together. So resident individual, resident partnership firm, they only can choose 44ADA and they should be engaged in notified profession. I have already discussed notified profession, legal, medical, accountant, company secretary, interior decoration, technology consultant, all these are considered as notified professionals. Notified professionals can choose 44 ADA. If they choose 44 ADA, and another condition is there. What is the condition for choosing 44 ADA? Gross receipts should be less than or equal to 15 lakhs. So notified professional came to you. Then you have to ask a question. In your business, if cash receipts are less than or equal to 5% of total receipts. If answer to this question is yes, then up to 75 lakhs, 44 ADA can be chosen. If answer to this question is no, then up to 50 lakhs, 44 ADA can be chosen. Is it clear? If 44 ADA is chosen, presumptive income is equal to 50% of gross receipts. Presumptive income is equal to 50% of gross receipts. And section 30 to 38 expenses are not deductible. Even interest on partners' capital, remuneration to partners also not allowed as deduction. See, if notified professional who is eligible to choose 44 ADA, if he discloses presumptive income, that means if he discloses minimum 50% of his gross receipts as presumptive income, then he is not required to maintain books of accounts and not required to get his books of accounts audited. However, if he discloses his income less than the presumptive income, that means under 44 ADA, SSE actual income is less than presumptive income. In such a case, books of accounts are required to be maintained. Tax audit is also required to be done if his total income is greater than basic exemption limit. So every year notified professional, you have to check if he is eligible to choose 44 ADA, minimum he should disclose 50% of his gross receipts as presumptive income. If he do not disclose 50% of gross receipts as presumptive income, then he is mandatorily required to maintain books of accounts and get his books of accounts audited only if total income is greater than basic exemption limit. Next, even notified professional also, if he is choosing 44 ADA, he is not required to pay advance tax in 4 installments. It is sufficient he is required to pay advance tax in a single installment, that too on or before 15th March of the financial year. Next, 44 AE. Any category of person, partnership firm, company, HUF, any category of person can choose 44 AE. But eligible business, which businesses can choose 44 AE? Those who are engaged in the business of plying, hiring or leasing of goods carriages, they only can choose 44 AE. Condition. What is the condition for choosing 44 AE? SSE should not own more than 10 vehicles at any point of time during the previous year. Then only he can choose 44 AE. On any one day in the previous year, if he is owner of 11 vehicles, he is not eligible to choose 44 AE. So on any one day during the previous year, he should not own more than 10 vehicles. Is it clear? Another point here, if vehicle is purchased on hire purchase basis, you know hire purchase, right? Ownership will be transferred upon the payment of last installment. Even though SSE is not the legal owner, still for the purpose of calculation of 10 vehicles, vehicle purchased on hire purchase will also be considered. So when you are calculating ownership of 10 vehicles, any vehicle purchased on hire purchase basis will also be considered. Next, how much is presumptive income? See, there are two types of goods vehicles. Heavy goods vehicle, light goods vehicle. Heavy goods vehicle means any goods carriage, the gross vehicle weight of which exceeds 12,000 kilograms or 12 tons. So any vehicle whose gross vehicle weight is greater than 12 tons or greater than 12,000 kgs, that vehicle we call as heavy goods vehicle. For heavy goods vehicle, presumptive income is equal to rupees 1000 per ton per month or per vehicle. Rupees 1000 per ton per vehicle per month or part of the month. That is the presumptive income. Other than heavy goods vehicle, that means what? Light goods vehicle. Light goods vehicle means gross vehicle weight is less than or equal to 12,000 kilograms or less than or equal to 12 tons. For light goods vehicle, presumptive income is equal to 7,500 per month or part of the month per each vehicle. Very simple. Heavy goods vehicle, presumptive income is equal to rupees 1000 per ton per month or part of month per each vehicle. For light goods vehicle, presumptive income is equal to 7,500 per month or part of month per each vehicle. Expenses under section 30 to 38 are not deductible. Here, I wanted to tell one another point. Vehicle purchased in the month of June, but vehicle was used from the month of August. Presumptive income is to be calculated from the month of June only. That means the day on which you are purchasing the vehicle or the month in which you are purchasing the vehicle, from that month only you will calculate presumptive income for that vehicle irrespective of the usage. Next, those who are choosing 44AE, if they disclose presumptive income, minimum presumptive income, then they are not required to maintain books of accounts, not required to get their books of accounts audited. But those who are choosing 44AE and disclose actual income less than presumptive income, then they are required to maintain books of accounts and they are required to get their books of accounts audited. If total income, no, that point is not applicable. Irrespective of the total income, if they disclose their actual income less than presumptive income, they are required to maintain books of accounts and they are required to get their books of accounts audited. So you can see SSC declares his profits lower than the presumptive income. Then he has to maintain books of accounts and get his accounts audited irrespective of the total income. Now, those who are choosing 44AE, normally how advance tax is paid? Advance tax is paid in 4 installments. So even the SSC is choosing for 44AE, no special privilege is there. He is also required to pay advance tax in 4 installments. Now these are presumptive provisions, right? 44AD, 44ADA, 44AE. For these presumptive provisions, if SSC wants to disclose his income higher than the presumptive income, then SSC can disclose on a voluntarily basis. Presumptive income is 70,000 rupees, for example, or presumptive income is 3 lakhs. SSC wants to disclose his income as 4 lakhs. Can he disclose? Yes, he can disclose. If he discloses his income more, he is required to pay more taxes. If he pays more taxes, whether income tax department says no, no. Income tax department will happily accept. So whenever SSC wants to disclose higher income than presumptive income, SSC can disclose. And from presumptive income, you can reduce chapter 6A deductions. And if there are any losses, even losses are also eligible to be set off against presumptive income. With this, we came to conclusion of the biggest chapter, Pgbp. One small thing, depreciation concept is there that I will do. Please revise as many times as possible Pgbp, very, very important. And I am keeping a lot of efforts to bring these videos to you at free of cost. Lot of equipment. Recently, 2 days back, I purchased 35,000 worth of mic. So I am not bothered about expenditure. I am incurring this much of expenditure. My only request is this benefit should not get lost. Okay, this expenditure should not get lost. Whatever the expenditure that I incurred to give you this benefit should reach to as many students as possible. So whenever, once if you are satisfied, I am saying only if you are satisfied with this content, then only share this content with all your friends. So they will also get benefited. I don't think any professor is providing content like this. So please share it to the maximum students, so all of them will get benefited and justification to the expenditure that I have spent will be done. Okay.